Yeah, for all those that hopefully remember who Bob is, Bob, why don't you give a brief introduction or reintroduction of yourself one more time? But this time, maybe give us a little something that we don't know about you, right? Like maybe outside of the industry, right?
Oh man,
Yeah.
sure. Happy to do so. I'm Bob Preston. I had a very successful property management company in San Diego called North County Property Group, which I sold about a year ago, year and a half ago, and have been since then doing consulting and podcast hosting my own through my company, my new company, Property Management Brainstorm. I've been in the property management industry for about 20 years. Something that you don't know about me, Taylor, you might, because I know you liked my Facebook post. I'm actually very much of, Jonathan and I were talking about this a minute ago. I'm very much of an outdoorsman, passion for the mountains, skiing, snowboarding, and hiking, fishing, all that kind of stuff, particularly the Eastern Sierra. And I have this new side hustle as a mountain guide or mountain host at Mammoth Mountain. And so it doesn't pay anything. It's just for fun, my free time, kind of a side hustle. But man, I get a lot of enjoyment about it. And over this last weekend, I got to open up their tube park, it's called.
Okay.
And I took a video of it sliding down in this inner tube. It was pretty fun. And they've got snow now and they're getting ready to open all the different runs. So that's a bit about me. People who know me pretty well know that about me, that I'm a big
Yeah.
skateboard guy.
Very good. And actually we have a new guest here. Granted, he's not a guest to either Bob or myself, but Jonathan, why don't you give yourself a quick introduction?
It's always great to be here, Taylor. Thank you so much. I am our community manager, Jonathan Cook. I've been in this industry for about 17 years. The last 5 or so, I've been a podcast host and content creator for several different companies, but I am the community manager here at APM Help. Spent a lot of time looking at what it takes to make some good content for this industry, some information that really helps property managers take a direction and kind of attack their goals. And that's what I've really been hoping this podcast and web series has been doing for all the listeners. And I'm really excited to see where this takes us as not just a piece of content, but also as a company and even an industry.
And as you can tell from his hat, he's another outdoorsman, right?
I am an outdoorsman. I spend a lot of time
he's
fly fishing.
Yeah, you spend your time like on lake shores and then bass boats and all that kind of cabins.
That's
and,
it.
Yeah.
It's a very Alabama version of being an outdoorsman. I'm really excited because I imagine this episode will probably launch right after the national championship has occurred. And I'm assuming that Alabama's probably going to make it there. Maybe I'm wrong. Maybe it's going to be Washington and Michigan. But look, they won the SEC. It's just better. Trent Ratliff, who was one of our friends in the NARPM industry, sent me a text message today to say, this is why the SEC made it. It wouldn't have mattered if it was Georgia or Tennessee or whoever wins the SEC is going to go. Because if you just look at the SEC championship ticket prices alone, it's $350 a seat for SEC, whereas like Pac-12, it's like $75. It's just the SEC cares the most about football. Who else are you going to put in the national championship?
And look, this wouldn't have been any better because the first couple topics we're talking about are all about benchmarks and metrics, and it's comparing like things like revenue per unit. So Bob, why don't we kick things off? And by the way, Bob has proposed the title of this episode to be all about maximizing profit for a high valuation, or essentially an exit. And I would hope anybody who's even remotely thinking about an exit is planning for the largest, best one. I don't know why you would exit otherwise, right? Unless you're being forced to, but then that means you weren't able to plan, let's say. So let's jump right into, let's talk about the key benchmarks and metrics, right? Especially specifically for property managers.
Sure, absolutely. I'd like to make a general comment about maximizing profit, first of all. Maximizing profit, we talked about this in our last episode. Being profitable is your moral obligation if you're an owner or even if you're a participant in a business, because you need to sustain the company long range. Now, if you're an owner of the business and you're listening in, the degree of profitability depends upon your particular way you like to run the company. Some people like to be actively involved. Other people want to step away and maybe they're willing to staff up a little bit more because they don't want to be there on a day in and day out basis, right? These just an example of the decisions. You can decide how profitable you want to be, but there are some benchmarks out there, thanks to our good friends at NARPM, where you can compare yourself to guidelines. Now, you have to be a little careful about that because the benchmarks in California might be different than benchmarks where Jonathan is in Alabama versus where Taylor is in Texas. So you always have to take that with a grain of salt, keep that in mind. But as a general kind of rule of thumb, not a bad way to look at the industry overall. Maximizing profit can be achieved in a lot of different ways through growth, through ancillary revenues, through minimizing staffing costs. We talked about that a little bit more yesterday, but we're going to dive into that a bit today. In terms of some of the benchmarks out there, let's see, where do you want to start? I think in terms of overall profitability, I believe the benchmark or the industry average is around 11%. We touched on that yesterday, which is really low. If you're putting a lot of time and effort into your property management company and only bringing out 11% profits, that's pretty low. The benchmark is more in the mid 30s. That's where most property management companies want to be. I've seen them as high as 40, approaching 50%. That's a little bit tougher to do, but that's
Yeah.
the benchmark. That's where you
And
want to be.
And I'd like to clarify here too, especially because APM Help is primarily on accounting, right? So there are different ways for people to, let's say, come to a profitability or net income number, right? I think we should clarify here a little bit or take a step back and say, look, you even touched on this, Bob. Different owners of businesses will run them differently. Some,
Right.
for example, like myself, we're set up as a C Corp. As a C Corp, right? Like arguably there's double taxation. So I shouldn't really pay myself that much out of a C Corp because I'm getting double taxed on that.
Right.
And so I'll likely try to business expense as much as I can on the business level so that ultimately I still benefit from these things, but it's only being taxed arguably once. When it comes to profitability, right, I think we should take a step back and say, at the end of the day, when you look at your numbers, because not everybody's going to be on the NARPM standards, not everybody's going to be running GAAP financials. Hell or heck, not everybody's even doing their financials, quite frankly. So if you really take a step back, it's ultimately what comes in, right, into the bank, right? So revenue or income minus everything that goes out, right, outside of purchasing or paying for assets, right? Granted, arguably, those are just financial mechanisms per se of like depreciation and all these things. At the end of the day, highest level, money in minus money out, what's left over, right? You can get to a percentage, right? Now, is that arguably the profitability we're talking about? Not necessarily, but rough numbers wise, that's how you need to be positive, right? If you're not positive, you're hopefully playing another game, which is growth, right? Explosive growth. But if you're not doing that either, realistically, your business is not going to be around for very much longer, right? Unless you happen to be like a trust fund baby, you have a lot of money in the bank.
Yeah, the other game, and I don't want to get anybody audited by the IRS or anything, but the other game that I talk to a lot of owners who want to just break even. And why do they want to break even? Because they run what are essentially a lot of personal expenses through the business.
Exactly. Yep.
Automobiles, travel, dining expenses, education, these kind of things that can be classified on your P&L, but are more like fringe benefits for senior
Yes.
management. Now, a little bit easier to do in an S corp or in some forms of LLCs. We're not going to get into corporate structure today, but you're right. So it depends. Now, these things start to become important if you start positioning your company for sale, because if you start positioning your company for sale, you want to show a higher degree of profitability, right?
Exactly. And
So
we'll
yeah.
come back to this, but those like fringe benefits, whenever you're doing due diligence, let's say, you're absolutely going to want to add those back because, and a lot of times, right, like I wouldn't say any good buyer, but most buyers are going to look for the last 3 years, right? As you're prepping for a sale, a lot of times you don't have the luxury of saying, let me start prepping today because I'm aiming for a sale in 3 years, right? A lot of times you're being forced to sell for whatever reason, and it's not a, oh, I've had 3 years of buffer to perfect my P&L. Just remember, even if you're not able to, let's say, completely perfect the P&L, you should be cognizant of, again, when someone asks for your profitability, right? They're probably not necessarily literally asking you for money in minus money out and the percentage of them, right? They're more asking about, look, if you were to take out all those fringe benefits that are one-time things that you bought a Mercedes when you could have bought a Kia, right? Kind of things, right? What is the long-term stabilized profitability of this business, right? After those fringe benefits, one-time things, what a lot of people will also call like seller's discretionary earnings, right? When you take those all back or add those back, what does it actually look like? So, Bob, let's start from the very, very top. The number
Sure.
one, I think, what truly is called top line, but let's talk about revenue. And let's focus this also. We're going to focus more so our metrics on per unit metrics, right?
Mhm.
Because again, then it gives a little bit more context. Because if I were to tell you, oh, this company makes 1 million and that company makes 500,000, you have no context, right? Whereas when we say, look, these are all per unit numbers, then you can extrapolate and be like, oh, my per unit is X, right? And it's a lot easier to actually compare. So
Sure.
let's start from the very top, Bob. Revenue per unit, what are those numbers?
Okay. It depends. I'm going to use the old
Mhm.
"it depends" comment,
Yep.
right? It depends on what company you're looking at, where they're located, and all those kind of things. There are certain more rural areas where revenue per unit can be a lot less. It depends upon how their fees are structured and how much in terms of other types of ancillary fees they have coming into the company. But let me talk about, I guess, industry averages, right?
Mhm.
The industry average, according to our friends at NARPM, is $222 of revenue per unit, and that's basically on a monthly basis. Okay, so that is the total sum of all. That's the industry average of all fees that come in on a property as an average. So you take your kind of top line revenue and you divide it by the number of properties you have, and that should pretty much be your RPU,
Mhm.
unless there are other types of revenue like real estate sales and things like that that don't count.
Yep. And let's touch, why does that not count?
Because you're talking about revenue per unit. If you sell one unit and you get a commission of $50,000, it's going to artificially raise the rest. So that wouldn't really be a fair apples to apples comparison from a property management fee perspective, right?
Correct. And what about like a leasing commission though, right? Because leasing commissions do happen fairly regularly, but it's not like they happen every single month. So are we really talking about revenue per unit as like truly every month this is coming in kind of stuff?
I think people count it in different ways,
Mhm.
right? So it depends upon your particular company. If you've got a unit and you're leasing it once a year and that lease fee, whatever that might be, is contributing to the overall revenue for your properties, then I personally would count that. There's also something that a lot of property management companies engage in. It's called just the lease up or lease only. Okay, so somebody comes in, hey, I want to do my own management. Will you lease it for me? Yes, they take a commission on it, which is usually going to be higher, like a property sale. Those typically would not be counted. All right,
Right.
this is philosophy. If you talk to the NARPM standards folks, they might look at things a little bit differently.
Yeah. So Bob, what's the actual benchmark then?
The actual benchmark's more in the mid 300s. 317 is the benchmark that NARPM says, hey, as a property management company, this is what you should be gearing for, right?
Mhm.
If you're not at the industry average, if you're above the benchmark, kudos to you. My RPU was more like in the 550 range. Okay. So I was maxing out. Of course, we're in a range of the country where San Diego coastal, we have very high rental rates and we were maxed out on ancillary incomes. This is why we've joked in some of these episodes about how many units do you have really doesn't matter when it
Yep.
comes to revenue because it's how much money you're making on each. So
Right.
my 550, as we can tell from this conversation, is like double the average RPU that's seen out in the market. So my whatever 500 units was equal to 1,000 from some other property management companies. But basically, that's something to really think about. If you're below that industry average, you really need to start taking a look at your books, what you can do to bring up your revenue in other areas and how your fees are structured and things like that. So that's a whole entirely different conversation.
Yeah. So before we even get into any of that, I do want to take a little bit of time. We've mentioned NARPM a ton, right? I'd love, Bob, especially because you've been involved much more than we have, or at least I have from a vendor standpoint. Can you pitch NARPM? Why is NARPM such a value add for our industry as a property manager?
For those who aren't familiar with it, and I think you have a lot of clients at APM Help who are not part of our NARPM for a whole variety of reasons, but NARPM is the National Association of Residential Property Managers. It's a group of people countrywide who I think in total we have about 6,000 members, and primarily to advance the industry. Rising tides raise all boats, and that's the attitude. And so you'll find people who really want to help each other. And as you can tell, like these benchmarks are published for the benefit of the entire industry. And it's a great place to learn. It's a great place to network. It's a great place to learn new concepts, hear what other people are doing, to get to understand innovation in the industry, tech stacks, and things like that. There are local chapters all over the country. I can't remember the exact number of chapters that there are, but I know, for example, in California, there's 11, I believe.
Mhm.
And then, so the local chapters meet on a pretty regular basis monthly. And then nationally, there are two main conferences per year. There's a national convention, which is for pretty much all property managers. And then there's another one called Broker Owner, which is more targeted towards the business owners and the brokers of the business, the leadership, if you will. And those tend to be higher level concepts, but maybe what we're talking about today. Yeah.
Sure. Yeah.
How do you maximize your fees and profitability?
Yeah. And for what it's worth, NARPM did an initiative with one of the vendors, I believe is Profit Coach, to create this set of accounting standards called I think it's what is it NARPM accounting standards or yeah, so it's the NARPM accounting standards or NAS. And so this is a whole nother initiative where the whole point of this is if you can standardize your general ledger, your like the way you're bookkeeping, at least from a corporate level, right, or your business level, it's a lot easier for hopefully yourself as well as others to like take a glance at the P&L and be like, oh, there's some problems here. Or, oh, like Bob's business is freaking fantastic, right? Because it's relatively easy to look at that and it's almost comparing oranges to oranges, right? Because at least you're now talking the same language, right? And so if you've not heard about the national accounting standards put out by NARPM, absolutely look into them. It's a great first step as it relates to even beginning, right? If you're doing your P&Ls, you're understanding the business, you want to be able to compare or just see like, where do I stack up against either other players in my market or just nationally? I think it's really good to at least have those.
Absolutely. And we're taking a look today at some of the higher benchmarks and higher ratios, if you will, the higher level ones, which probably most companies could figure out on their own. But the NARPM benchmarks and the NARPM standards allow you to dive really deep into certain things, particularly when it comes to the type of labor. Now, we're not going to get into that today. And if your books are organized the same way that they're recommending, then the benchmarks are more meaningful to your particular company because you can calculate those ratios in parallel to the way that the NARPM benchmarks and the NARPM standards suggest you do that. So it's very helpful. And to Taylor's point, when I sold my business a year and a half ago, pretty much everybody I showed my financials to understood them very easily because they were organized in a way that is common within the industry. So it just totally makes sense. If you think someday you might want to exit, whether it's through succession planning, turning them over to someone within your company, to a family member, or selling, I highly recommend it so that they have the standard that will carry forward with the company for years to come.
Yeah, absolutely. Okay, so let's now talk about profits, Bob, because revenue is great to your point. A high number of 550 doesn't mean anything if your profit per unit's 5, right? What's the industry average and what's the actual benchmark?
The industry average is $120 per unit average profit now. And to Taylor's quick.
I think actually, Bob, I think it's 29. You're talking about ancillary revenue there.
Oh, sorry. $29. Yeah, sorry. My bad on that one.
No, it's all good.
I got ahead of myself. And $78 is the benchmark. And to Taylor, quick back of the napkin math, you're talking about, okay, your revenue minus your expenses, right? So here's where it gets a little trickier because if you're throwing things into the business on the expense line, like expensive lease cars and dining out and all this kind of stuff, that does hit your bottom line. So you might have to really get the true number, you might have to back some of those things out.
Right.
Comes to how businesses want to run their expense lines, how profitable do you want to be, but they're good guidelines, right, to strive for.
Yeah.
And maybe that's a good segue because I was talking about ancillary revenue a little bit, is that, all right, how much of that should be management fees versus how much of that should be ancillary revenue? And I think that's a whole nother discussion, right? The industry average is that management fees, which is the percentage or the fee you charge to manage a unit, is typically around 62% of the total. I try to get it in my business to be 50%, right? And the whole point of that is, hey, recurring revenue in other ways. Let's not just make it about the management fee. Let's make money in other ways, which overall kind of reduces your work, your risk. And then about 38 to 40% is ancillary. So that's the way that the industry averages work. Industry average in terms of ancillary revenue is $120 per unit, 140 is the benchmark, right? So
Cool. So we've talked a lot about profit. We've talked about ancillary revenue. We've also talked about top line revenue per unit on average. What are the benchmarks? How do we like, how are property managers actually making the money, right? Obviously, we're very familiar with the core management fee itself, right? But even with the management fee, there's a gazillion different ways to like charge management fees. Let's dive into this a little bit more.
the most common, I believe, and some people out there might argue with me, the most common is on a percentage basis, right? I think the
Yep.
typical is somewhere between 7 to 10 and 12% in some places, but 8 to 10 seems to be the average, around 8 to 10%. So if I'm charging $100 of rent, then my fees, if it's 8%, it's going to be $8, right? Just do the
Yep.
math on that. A lot of companies, though, have tiers, if
Mhm.
you will, where they have a standard, a basic program, a standard program, platinum. You get it, right? Where they start throwing these things in, and there's a bunch of a la carte items that are maybe not included that could be charged as ancillary fees that get thrown in. Reminds me of that those bundle ads on State Farm, all these kind of home, auto, and you're bundling them. You bundle it in for the higher tier, or the other common thing is to give people certain guarantees
Mhm.
for a higher or a premium on their management fee. The other common structure is a flat fee. I'm not a fan. I'm not going to lie, but what has happened in certain areas is that somebody way back when started charging flat fees, 150 bucks to manage a property, whatever, and those tend to be usually tiered, like at a lower class C property, maybe it's 100 bucks, then you go to 120 and 150, some kind of tier structure.
Yep.
Issue with that is harder to give yourself a raise, right? If you're charging a percentage, which is what we did, and your rents are going up, which is pretty prevalent over the last 20 years in California, every year you're basically giving yourself a raise.
Right.
So that's pretty nice,
Yeah,
to
your
give.
incentives are more aligned, right? If you're essentially incentivized to help increase the revenue on a unit, right? Versus flat fee, it's okay, I'm just going to do my job and that's it.
Now, we had some really nice properties in our portfolio, some that were renting for $12,000, $15,000 a month.
Yeah.
So
Wait, so
the
you're saying you were getting like $1,200 to collect rent, Bob?
That's right. This is how some owners look at it. Well, why am I paying you so much money when the guy down the street who's renting for $4,000, he's
Yeah,
paying so much less? And look, it's not a bad question. Sometimes we would compromise a bit on that, but these more expensive properties are also very complex,
right.
right? And you're dealing with high net worth individuals who are renting them that are
Yep,
very picky. And
right.
so it never fails. Every time I negotiated, I always regretted it, right?
Yeah.
Even on these really expensive
And for what it's worth, I don't know if anyone's seen like all the influencers, the TikTok real estate investors essentially coming around. But if you look at all of their pro formas or analyses and their spreadsheet kind of things, management is always a percentage, right?
yeah.
Because they all learn eventually, and everyone will learn eventually. You ultimately get what you pay for. So if you're collecting $12,000 a month in rent and only paying 150 bucks in management fees, right? Like you're going to lose somewhere. Let's just put it that way, because that's unsustainable, unfortunately. And until someone cracks the nut of being able to actually manage a 12,000 unit or $12,000 a unit monthly rent kind of place for 150 bucks, like maybe that'll change the industry. But at least so far, it seems to have been you're either going to give up on deferred maintenance, there's going to be some big expenditure you're going to have to do, or they get crappy tenants. There's always some reason that you can pinpoint back down to this was misaligned incentives, right? You're paying 150 bucks a month. They just did their job. They found a tenant, got them in. That's it. Versus you incentivize them appropriately, right? And hopefully they take care of your property like their own.
Now, I've seen a lot of derivatives of these two different models, flat versus. And by the way, I think what I was going to say earlier was in certain regions, whether it be within a certain metropolitan area or certain region of the country, I talked to a lot of property management companies who are like, oh, Sacramento, for example. Sacramento's flat rate. Like
Mm.
all the companies charge a flat rate. I'm all, really? All? And there's this sort of belief that, okay, if you deviate from that, it's going to be tough to get business because the competitor who they're going to see next is charging a cheaper rate. I always wanted to challenge that. And if I were the owner, I would have. One of the other things we see is that a lot of companies, and we did this too, we had a minimum rate.
Mhm.
Okay, for a percentage, but look, our minimum's 165.
Right.
Okay, so if you have a $1,200 rental property, we might consider taking it, but you're going to be paying 165, which is more than 8 or 10%. The other thing is some combination of the two, right? So it's a
Mhm.
flat fee up to maybe a rental of $3,000. And then above that, we charge a small percentage or vice versa, right? There's different hybrid, different sort of derivatives of that work for different companies. And typically that's evolved over the period of time based on customer feedback for their area.
Yeah. What about, so I'm going to add in a topic here. What about maintenance markups? I feel like this is one of those where if you're a landlord, a lot of times you're like, man, you're marking up everything. What's your incentive to go find me the best, not as the cheapest, but let's say the best subcontractor or vendor, right? When it's, if you make 10% on everything, what's your incentive, unfortunately, is go find the most expensive option, right? Because you're going to make more money for it.
This might be one of the most, well, it might be the most emotionally packed
Yeah.
in the property management industry.
Yeah.
And
That's why I'm asking it, Bob.
it's an interesting question because if you had a mastermind group of, say, 15 property managers and you said, do you guys mark up on your maintenance? You're going to, and how do you do it? You're probably going to get 15 different answers.
Yep.
A lot of property managers, property management companies who are mom and pops, they brought people in because those people trusted them. Oh, we're never going to mark up your maintenance. We don't do that. The only money we make is off of our fees and yada yada yada. And then others are, well, hey, maintenance isn't part of being a property manager. Maintenance is its own separate thing.
Yeah.
Being a property manager means we find a tenant, we rent it, we find out what's wrong, but fixing the property and taking the effort to maintain it, and similar, a lot of companies have the same attitude about preparing your tax documents. That's not part of being a property management company. We'll do that for you, but we're going to charge you. Other companies, they don't want the a la carte thing. They just say, nope, we'll do everything and it's for a flat fee. And those are typically the companies that are less on the proper profitability scale than the ones that are the higher range, the 35 to 50% that you see in ARPA.
Yeah. And it's at least everywhere that every single situation I've seen, whether they mark up or not, right? Inevitably, maintenance and upkeeping the property, turnovers, all of that, it is absolutely a pillar or a leg of the stool for property managers. It is a necessary thing you've got to do. And I think one interesting thing from an accounting standpoint is if, let's say we go down the path, let's explore this, right? Like you don't do any maintenance markup. But inevitably, your tenants are going to come to you for maintenance, right? "Oh, my light bulb is whatever, come replace it." Like you have to hire someone to handle that. And
Yeah.
so now all of a sudden that person is a pure expense to your P&L effectively. Whereas if you do mark up or you do have an in-house maintenance team, that person no longer is strictly an expense. That person can arguably generate revenue now as well. So there's
Yeah.
some pretty interesting things about this that absolutely I feel we should be honest with ourselves in this industry, which is like everybody who's in property management, unless you're doing lease only, right? You're going to be involved in maintenance. It's one thing to say, oh, we're never going to mark it up. And that means you got to make it up somewhere because you got a head or multiple heads you got to pay for, right? To coordinate stuff. Like you're inevitably going to need those people, and those people cost money.
I've got religion along the way on maintenance markup. And when I started, I only had a few problems. Oh, hey, we're not going to mark up your maintenance as part of our service. And then I realized, hey, this is really hard to make a profit in this business.
Yeah.
And then the company had grown to, I don't know, 50 to 100 doors, something like that. And I was looking at our bottom line and I was looking at the amount that we were paying out to vendors, basically
Yep.
subcontractors. And the year that I finally got religion, it was, I think the amount that we were spending on repairing other people's properties was about $300,000.
Right. Right.
And I'm like, hey, we should be getting a piece of this somehow.
Yeah.
So there are a lot of different ways to do it. Some people have in-house maintenance where they have their own techs, they have their own trucks, they basically start a maintenance company. I ran mine. I happened to be a general contractor, so I ran mine like a general contractor business. We talked about this in one of the other episodes. Other companies will just charge a facilitation fee, which I think
Right.
is very fair.
Yeah,
Okay.
it's very fair. If anything, I'm trying to say, don't be scared to it costs money. I don't know about anybody else, but if you go call a Serve Pro or any of these big franchise like vendors to do anything in your home, like the trip cost alone now is like $150 minimum. Just to come out and say hi, right? Like I shit you not, this literally happened yesterday. One of my friends is a doctor. He renovated a home. He finally turned on the gas and was like, I don't have any hot water. And of course, there's something wrong with his hot water heater. And instead of calling the plumber who renovated his house, he was like, "This is." So he called the Rotor Rooster one. It's one of the national franchise ones. Guy came out, spent like 15 minutes like mucking around doing some random thing, and he couldn't figure it out. So he just unplugs the gas line and waved it around, just replugged it back in, and the pilot line came on. It worked. Guess how much he wanted to charge for that?
I couldn't even guess.
$330.
Yeah, just for the trip to get there.
Yeah, it was effectively a trip cost, and then I helped you diagnose. Like it works now. I prevented you from having to go replace your hot water heater. Right? It's what you like. Don't, if anything, if you're a property manager out there, don't be scared to charge or mark up if you've got dedicated or very good preferred vendors who will pick up your phone. Right? Just understand the other side is not greener. If a tenant or an owner were to try to reach out and solve these things themselves, they're absolutely going to pay up the wazoo for that stuff as well.
Yeah, I see.
Yeah,
Jonathan.
Jonathan.
There's another point that I think is interesting also when it comes to scheduling these maintenance visits and these vendors to go out there. And it's the time on the phone, just getting them out there. We all talk about how much time can we save people in this industry. The reality is if you have to sit on the phone for an hour and a half to figure out when the representative is going to get out there and schedule it with someone, that alone, just scheduling and being on the phone is worth some fees. And I feel like that gets glossed over as much as any other point that we're talking about.
Here's the other aspect is that the worst properties take up the most time of your maintenance coordinators. So the very first thing we implemented, and it was very fair. No, I had a few clients who got upset about it, but not many because they understood it, is we just implemented, okay, every time there's a maintenance call, we're going to charge you a facilitation fee of $25. And you know what? That made a huge difference because there were some properties where you've got some awful tenant who's super picky or treating the property like crap, or maybe it's just a class C property where the owner doesn't want to do anything. There's things constantly going wrong. Okay, this sort of evens the scale a little bit, if you will, in terms of the amount of time you're spending on a class A property versus a class C property. The other thing, the other reason is that we talked about like charging for facilitation and whatnot. Man, owners who have home warranties.
Oh man. Oh, that's even worse.
It's even worse.
Oh yeah. Oh.
Okay. It takes forever. Okay. So you're on the phone, you're waiting. So this is the kind of thing that used to drive me crazy. Oh, you got to use my home warranty because they'll replace my hot water heater for free. Yeah, but they're not going to get there for 4 days, 5 days. And in the meantime, the maintenance coordinator is facilitating this whole thing. The tenants without hot water, we're getting yelled at, and we can't mark up maintenance. Are you kidding? The people who are advocates of charging for maintenance will point all these things out, and I tend to agree with that. See a lot of different models out there. Like I mentioned, some just charge a facilitation fee. Some are just, hey, we mark everything up by 10%, some kind of a fee. And I think where people get stuck with some of these ancillary fees and rolling things out is when they've started their business a certain way. Mom and pop have started it that way. You've accumulated a group of owners, and you're afraid if all of a sudden you roll something new in that people are going to get mad and they're going to leave. But I tell you, that's no way to run a railroad. You cannot be afraid of that. At a certain point, when you start to scale, you get to a certain property count, you've got to change your thinking about that kind of thing because you need to be looking to the future, especially if you're trying to scale to that 800,000 door mark, you're trying to maximize your profits and you're trying to exit someday with an acquisition.
Yeah. All right, let's now talk about, so we've talked about these ancillary revenues, but I feel like we should give some specifics, right? So outside of management fees, leasing fees, I think a lot of people understand application fees that you may take, which by the way, application fees are now becoming a pretty murky fee per se, because some certain states that are very tenant friendly, for example, make it so that you cannot mark up applications right? Or if you do, it's got to be reasonable from a labor standpoint. It's a very murky area. And but expand upon what other fees are there and maybe how profitable are they?
Yeah, absolutely. Okay, first of all, you're absolutely right. You need to understand what state you're in and what the laws are. In the state of California, you're able to charge a tenant an application fee, you're able to charge them their rent, and you're able to charge them a security deposit. And that is it. Technically, you're not supposed to be charging them anything else for the rental of the property.
Hmm.
Now, there are different ways to get around that in terms of ancillary fees that you can charge both owners and tenants. Okay, if you want to, if you're going to have a pet in your property, there's can be pet rent. Okay, you can't charge a pet fee in California, but you can charge pet rent. Now, I'm not going to frame everything in the state of California here, but those are common things that would be called ancillary fees. To your point, Taylor, some companies will charge, and where in states where they're allowed, they'll charge a leasing fee to the tenant. They'll charge a fee to meet them there, do an initial inspection, move them in, a move-in fee. The list goes on and on. If you listen to some of the people in the industry, they're pretty much charging for almost everything. Every time a lease changes, okay, you got a group of roommates, somebody wants to drop off, you're putting someone new on the lease, you're dropping somebody off, you're qualifying them again. Okay, that could warrant a fee, right? My favorite, which we always had the hardest time getting our property managers to charge, is what we consider to be out of scope of services. Okay, we talked about some of that stuff that, hey, it really shouldn't be included in property management in the first place. I think the favorite one was when the interest rates were really low. We used to get owners calling all the time, hey, I've got an appraiser who wants to come to my property. Will you send someone over to meet the person property? Yeah, sure. But you know what? That's not part of my property management duty. So I need to send somebody over there. We're going to charge you $50, $75 an hour or whatever a fair rate is. Now, getting the property managers to track that kind of stuff is
Oh,
sometimes
it's
quite
that's
difficult.
difficult. Yeah.
Yeah, we already talked about maintenance coordination. That could be considered an ancillary fee. A lot of companies will charge an annual technology fee or tax document preparation fee, which I think is also very fair. We finally started doing that. I think towards the last 2 years, we were charging an annual fee, which I thought was very reasonable. I think it was 149. I've seen them as high as 299.
Yeah, I have too.
We're all running these property management softwares, Appfolio, Buildium, whatever, Rentfine. Those cost us money, right? That's who says that's directly overhead. We're doing that for our clients. It's a service to our clients, to their tenants. Charge them a fee for that on an annual basis. Yep. Same come January, February, when you're going through all the 1090. For those who are out there who are property managers and in a property management company, you know what I'm talking about. Come January, the accounting department, all hell breaks out because they're really focused, and Taylor, this too, from in help. I'm sure you help a lot of your companies get their 1099s ready and in order, but that's a big effort. Right?
Yeah. It's not only a big effort, but it's expensive now, right?
Yeah.
Not every owner is going to allow you to e-file or effectively. I mean, you can always e-file to the government, but they're not going to necessarily want the e-disclosure, let's say, or just getting my 1099 copy from via email. And so you literally have to snail mail that stuff.
Yeah.
Right. And now there are services that effectively make it relatively easy or affordable to do. But it's if you're small or aren't using these services, like I remember back in the day, because we did this for a couple clients like 5 years ago, but like we had to buy like the red copy bees from
Yeah.
like Amazon or whatever. I bought a freaking
Right.
printer. Yeah, no, yeah. And they come in like these pre-assembled packs of like 10 or 20 or however many. And I remember having to like print them and stuff envelopes. And like at the time, like we didn't have the label, like the envelope printer kind of thing set up. So I was literally writing random recipient addresses essentially for a client. That is not easy. And that stuff takes time. And yeah, so and let alone, God forbid, all of the questions that owners will give, where it's because the softwares don't make this easy or accurate per se, but it's like, what do you mean my income is this amount, right? Especially with Appfolio when it comes to prepayments that were collected late December, right? Like the interpretation Appfolio has for that is if it's collected in the calendar year, even if it's a prepayment, it's considered income that's needs to be reported on 1099s.
I used to spend probably, I'm no joke, probably hours on the phone in favor of helping owners understand their 1099.
Oh, no, absolutely. And unfortunately, it's never an easy, let me show you a 12-month cash flow where the numbers match exactly kind of thing. It's always take this number, subtracts that number, right? And then you'll get to this number. And that's the hardest thing to explain to any owner because they're just like, why can't you make it? Just make it match.
Okay. I want to get to one of newest forms of ancillary fees here in a
Yeah.
minute. They're obviously the other basic ones: late rent fees,
Mhm.
non NSF fees.
NSF fees. Yep.
And absolutely, every property manager should be charging for those. If you're not, you're being too nice of a person. Don't do that.
Yeah.
Property inspection fees.
Mhm.
Most companies are charging for that nowadays. Okay, some companies start their company saying, "Hey, if you come with us, I'll do a move-in inspection, and I'll go like once a quarter and inspect your property." That
Right.
works great up to about 50 properties.
Yeah, and then you're like, we there's too many
I've had a
properties.
history of
Yeah.
people. It is not sustainable.
Yeah.
You know, you're going to be paying a full staff to do that.
Yeah.
The newest one, and I remember when I first heard about this, it was like the first time I heard about the iPhone. Like I'm dating myself here, back 15 years or whatever. That when I first heard about the iPhone, I'm like, that is the dumbest idea. What,
Mhm.
you're gonna have a camera and a phone and all this stuff on basically just this handheld thing. So anyway, that shows you how much I knew about that. But when I first heard about it, it's called the resident benefit package, right?
Mhm.
So here you're not only doing things for the owner, but you're providing benefits to the tenants, and you're rolling those up in a package, and then you're charging them, and you're saying to the tenant, hey, this is mandatory. If you come with us, you're going to be charged this extra fee for these things that you get. At some point, this might be something that gets tested in some of the states, whether or not it's legal,
Right.
but the resident benefit package typically includes things like different types of insurance coverage for renters insurance. It covers air filters. Our good friends at Second Nature are big into the what's known as the RBP program. It can cover refrigerator filters. It can cover, you get credit for paying your rent on time,
Mhm.
so that you get these sort of points, almost like your credit card rewards card. So all these things are rolled up into this package and then offered to tenants. For those people who aren't yet doing this, I highly encourage you to do it. It's the wave right now in the industry. And I'm guessing I have no way of knowing what the percentage of property management companies that are charging it. You might know better than me, Taylor, but it's getting up there, and most people are doing it in most major markets.
Yeah, most people are doing it. I will caution and say though that there are absolutely states now that are
Yeah.
looking at these RBPs or benefit packages to truly figure out like, is there actually value being added here and how is it being rolled out? Because a lot of these historically have been a opt out kind of scenario,
Yep.
unfortunately, versus an opt in. And so just be careful when you do try to roll these things out. Absolutely, there are benefits, hopefully, to these packages. And what about an owner benefit package, Bob?
This is starting to become being kicked around a little bit too.
Mhm.
I know these things are starting to pop up.
Mhm.
And the issue here with owner benefit packages is that people have tried this before in the
Mhm.
form of different things that are the no worries plan, right?
Yeah,
One of
it's
them
like the
was
eviction guarantees. Now they're doing rent guarantees, right? There's like
right.
lease guarantees essentially, where it's like if a tenant that we signed churns or leaves before the 12-month or before the lease ends, we'll release for free. There's a lot of these guarantees that go to the owner, right?
That's fine if you're not charging for them, right? If you're
Mhm.
saying it to make your program more attractive. Okay, the standard program is 8% and you get this. If for 10%, you get all these other things thrown in, right? Where people got in trouble, I know specifically in California, was that they were charging a certain amount for eviction protection. Basically went like this. Hey, you for $150 a year or whatever, we'll guarantee that there's no eviction. And if there is, we'll cover the costs of the attorney and the
Right.
the client. The problem is that if you never spend the money, then the state of California was saying you owe that money then back to that person. You can't just charge something for a service that's never been performed.
I
So
see.
there were a lot of companies in the state of California that really got it handed to them, and they had to pay back a lot of the money because they got in
Got it.
trouble with PRE.
Yeah.
This goes back about, I think, 6 to 10 years ago.
Yeah, and I do think along these same lines, right? You need to be very careful because I am hearing a lot of murmurings of like property managers trying to roll their own programs like this,
Yep.
and you're towing the line between like being an insurance broker or not broker but like being an insurance underwriter, and a lot of states require licenses for that kind of stuff, like you need balances available, right? Just be very careful when you start getting into the guarantee world. Right, just because you're not calling it an insurance policy does not mean the state or regulators would see it that way.
Yeah, and there's now security deposit, no security deposit programs that are popular.
Yep, yep.
Some property managers are doing that. Okay, Mr. Customer, we're not going to charge you a security deposit. We're just going to underwrite it ourselves, and this is how we do that. We charge this amount of money. That's what we did with our pet program. We charge pet rent. And then we told the owners, look, if there's pet damage beyond the security deposit, we'll pay for it. So we would always take a portion of that pet rent. We would set it across into sort of this, we called it a provision fund, and would build it up, and we were self-insuring ourselves against pet damage. That's how that worked.
Yeah.
So balance sheet liability, but the cash really isn't around, cash for other purposes. So.
Yeah. So just be careful, because we are absolutely talking about some regulated spaces, depending on the states you're in. Just be very careful about these things. Yeah. Okay, cool. And then let's talk about churn, right? Because we've talked about revenue, profit per unit, maximizing the fees, different kinds of revenue streams as it relates to managing properties, right? But all this goes away if you lose the management contract, if you lose the rental, right? So let's also talk briefly, what are the typical reasons that we've seen when it comes to losing an owner or losing a management contract?
Okay, churn happens, right? And so to think that you're going to have a portfolio that doesn't have churn, you're kidding yourself. If you're new to the business and you're thinking about getting in, and you happen to be listening to this to educate yourself, you have to be prepared for it. The problem is when you're doing your forecast for the new year, which I hope a lot of companies are doing. By the way, I advocate that as we're headed into 2024. Every company should be doing that. You have to forecast enough in terms of growth so you cover your churn. You have to bring on new properties because you're going to lose some. The reasons for churn are many. The most common ones would be, we don't like you. You screwed up my owner statement. You charged me for something. Therefore, you're fired. We're going to go to a different property manager. Big red flag we always had when we'd talk to a new client and they had a previous property manager, maybe sometimes 2, 3 property managers. They fired that person. That was always a red flag, because that means something happened that they became unsatisfied with. So just keep that in mind when you're bringing on new properties. Another form of churn that we would be proactive sometimes with is we would fire owner or property. Hey, this is too much liability. You're argumentative with us on a regular basis. You're asking for too much in terms of personal handholding or too many concierge services. We can't run it this way. We're going to let you go, right? That's another way. Selling your home. We talked about this a little bit yesterday, Taylor, in terms of the property management companies that are doing real estate sales. Hey, right now, not many people are selling. So that's a nice thing. When the market was hot, rates were low, they had real estate agents sending them letters right and left. Hey, I can sell your property in a week, all this kind of thing. A lot of properties were sold and a lot of churn took place in the kind of 2021 to 2022 timeframe when the real estate market was really hot.
Yeah.
So that's a big one.
And that's a double-edged sword too, because as you lose units due to churn, whatever it may be, it is very difficult to lose or let go of your people, because a lot of times you staff up your people to meet the capacity or meet the demands. And if you all of a sudden lose 10%, right, of your units because the market's hot or whatever it may be, it's not like you can say, Bob, I'm just going to pay you 10% less now. You can work 10% less every day, because like that, it just doesn't work. So instantly now, guess where you're taking the hit? You're taking the hit on the P&L, on your profitability effectively, right? Because you have those fixed costs, and that's the business of property management, right? So Bob, why don't you talk about the benchmarks real quick as well? What are the averages, and where do people want to land?
Yeah, the churn across the country is industry average is about 20%. So you can compare yourself to that. If you're above or below that, kudos to you if you're below it. 10% is the benchmark we all try to shoot for. My business was typically in the 10 to 15%. I think we had a couple of years that were getting closer to 20%. And it's always shocking when you look at it at the end of the year and you really stop to count how many properties you've lost, because as I mentioned, you have to make that back up. I want to add one side note here, and that's that there's a lot made of the accidental landlord in the industry. Like, oh, we don't like to work with accidental landlords. And what I mean by that is somebody who maybe takes a job in a different city. They have one property. They're going to go live somewhere else for 3 or 4 years. And in the meantime, they want to rent
out. Yeah.
Yeah. That's an accidental landlord. They didn't really intend on being an investor. They have one property. Okay. If you have a portfolio full of accidental landlords, if one guy decides they don't like you, you're only losing one property. If you have big investors who have 25, 30, 50 properties and they decide to go somewhere else, that can really sting. So just make sure, and my advice would be just make sure you have a good balance between all that. It's great to get to 1,000 or whatever. If one client makes up 500 of those doors, okay, this also comes to valuation when you go to sell. Okay,
Absolutely.
if that guy goes, your recurring revenue goes with it. So
No,
just
absolutely.
yeah.
So I think, Bob, you're too good at these. You like lay up the segues here, right? All right, so let's talk about what do exits actually look like. And I think this is a massive topic that I think we can talk about a lot because not only have you been through one and then was at essentially a larger company that was doing a lot of these, right? Like over at APM Help, we have seen a gazillion acquisitions from both the buy and the sell side. And we definitely have our preference or our opinions on how they should be done. But realistically, right, like just deals are happening at all times and everyone eventually is going to need an exit, right? Whether you care to admit it or not, right? Everyone dies, right? And eventually, I don't know about you, but most kids who grew up in property management want nothing to do with it. So if you're planning on your kids joining and taking over the business and being successful at it, the odds are not in that favor.
Yeah.
Yeah. Well, why don't we start with Bob? Who are the potential buyers of a management company?
There are a lot of different ways to skin a cat. There are business brokers out there that are in markets who just are bringing investors who want to get into a different type of market, right?
Hmm. Hmm.
So there are business brokers, just like there are business brokers selling gas stations and liquor stores and all the.
And real estate. The
Oh,
whole the realtors and brokers they broker real estate transactions.
that's right. I had a friend who bought a bunch of, I think they were sport clip, like sight unseen, went with a broker, bought 10 sport clips or something. To me, it seemed crazy. So there is that route, that there is that avenue. There are
Mhm.
also local people who are looking to aggregate properties. And, there are a lot still to this day, there's still a lot of real estate agents who aren't really property management companies, but they have some small portfolios, 10, maybe 15 to 45 properties. So property management companies are trying to buy those. Those are a property portfolio buy.
Mhm.
And then there are regional players as well, companies that want to expand all over Southern California, Orange County and Long Beach area. There are people that are gobbling up properties and opening up into different areas. And then there are the national players, right? There's the people like Pure, who I sold to. There's Evernest, who's out there, HRG, Home River Group, Rome, RHOME. There's quite a few. There's several. Right now, there's also Poplar. Right now,
Mhm.
people aren't being as aggressive in
Mhm.
buying companies. You and I talked about a year ago when you were taking a look at some of this yourself, and hey, it's a difficult time to offer really good valuations. So
Yeah.
they're still out there and they're still looking to expand and grow nationally.
No,
And
absolutely.
those would be, for lack of a better term, fall into generically categorized as roll-ups. The whole
Mhm.
idea is you take companies that have recurring revenue. And this is why your recurring revenue is so key. Your property management fees, your ancillary revenue, stuff that you can count on, keeping attrition down, stuff that you can count on month in, month out. This is really attractive to these companies that are doing roll ups because they can take your company, they can roll it up with maybe 50 others across the country, standardize on operating procedures, provide some risk aversion because they have properties in different segments of the country. So if the state of California falls off in an earthquake into the ocean, they don't lose their entire portfolio, right?
Mhm.
They only lose a portion of it. That's really the motivation, and the thinking being that rolling up 50 companies in like order, the sum is worth a lot more than the individual parts. The valuation only goes up for these people who are doing this kind of a project.
Yeah, and I think a good thing to also mention here is if you are prepping for an exit, right, it's good to get a lay of the land, but also ultimately ask around and get to know the game that they're actually playing. Figure out, and the knowledge is there, right? It's just sometimes you just got to be willing to ask, right? But like a roll-up player that's typically, and you can tell who they are, they've raised money, right? You'll be able to Google search and figure out like, oh, they raised $50 million, or they have a 50 million debt credit facility, right? Those are the kind of players that are private equity backed that will typically be hopefully a little more sophisticated, but also pretty, this is our process, this is our formula, and that's it. Versus you've also got, you mentioned regional players that are typically like people that have organically grown, right? Maybe they're funded by bank debt, right? But they didn't necessarily go and raise money for it. And then you've also got your Joe Schmo real estate company that's down the street that potentially has always been looking at you and, man, why can't we ever beat them or whatever? And then timing has it that they're still young, you want to retire, and maybe so you can make something happen. Yeah. And what about the whole giving it to a family member, Bob?
I was going to say, so there's, before you just get into, hey, I want to sell my company, you should think of, okay, what's the over, I call it succession planning.
Hmm.
So there's going to be some succession plan. And if I'm in my 60s now, by the way, it's one of my areas of specialty in my consulting business, succession planning and helping with acquisitions. So if anybody out there is thinking about this, it's one of my areas of specialty that I'm helping companies with. But
Hmm.
what are you going to do with your company? To your point, I knew that I wanted to do something different. I knew that I wanted to plan for the future. I looked at my succession as probably three different options. Number one was to maybe expand myself. There are banks out there that are giving loans for this exact kind of thing.
Hmm.
Maybe get some investors involved myself, start buying smaller companies, hire somebody to run it, expand, expand, expand. I just sit on the board of directors and maybe take my annual dividend, get a fee for being on the board, and then retire away from the day to day. That was one way to do it. The other way would be to maintain. Okay, hey, I've reached a level where this is nice. It's the company's shedding a certain amount of profit every single month. I can take that as my compensation, flip the keys to somebody who's in the company. It could be a family member. And then, of course, the other way would be to say, okay, no, I really want out and I want to sell.
Right.
I had a family member in the business, my son, and after a lot of talk and after a lot of consideration, we just felt that that wasn't the best way for me to go. My main concern was I didn't want to do something that I would regret once I get to an older age. So if all of a sudden I'm having somebody else run the company and then I'm just in an advisory role, but then 10 years down the road, that team decides, hey, I don't want anything to do with this anymore. All of a sudden, at an older age, I'm back in operating this company that I really don't even want anymore. For me, it just made more sense to do a clean break. That was my personal decision for me and in conjunction with my family. But
Yeah.
that's just how I saw it. But yeah, there are a lot of different ways to approach it. And I think everybody should have a succession plan, even if they're not planning on departing the company anytime soon,
Hmm.
because it's the kind of, hey, you may get hit by a bus plan.
Hmm.
Somebody needs to be, you need to be prepared. Somebody, there should be something somewhere that sketches out the plan that, hey, if something happens to me, this is what we do.
Yeah. And Bob, what about the actual structure of an acquisition, right? Because where we've seen some pretty interesting structures in other industries where if you do have, let's say, a little bit of time, let's say 5 years or more, there's something called qualified small business stock where you can get a buyer essentially tax-free gains upon exit and things like that. But a lot of times in the property management industry, there's no hard assets outside of maybe a car or things like that. So the typical structures for a purchase of a management company or let's say their portfolio today.
Look, I know about the ones that I only, yeah, I know about. I'm sure there are lots of different ways to structure
Mhm.
this. The two basic ones would be a company sale, stock sale, where you're basically, to your point, selling the whole kit and caboodle, right? You're selling stock, you're turning everything over to another buyer. They own 100% of the company, including all the assets and the liabilities. This is more common when there are actual assets that are owned that are valuable, I think. And maybe if the corporation is another, has other business units. The more common one in today's market is just the asset sale, where people are pretty much buying your contracts, right?
Yeah.
Your contracts. And they are taking on some degree of liability because they're typically taking on your people with them. But the vast majority of it is an asset sale, right?
Yeah.
And from tax perspective, that gets taxed beneficially as well versus other forms of just property sale. So it's an asset sale that's intangible, right?
Mhm.
Because it's a contract. It's not a physical piece of property. So the two have different taxation, basically.
Yeah. And just so everyone who's listening gets a little more context, asset sales are very common in this kind of industry. Primarily, again, it's all goodwill, right? It's all relationships in these contracts, but there is a lot of potential liability when it comes to a management company. We had prior episodes talking about the insurance you need, and you deal with a lot of contract. You remember we're like 200 units could easily be like how many four or sorry, 1,000 units could easily be like 4 to 6,000 stakeholders a year, right? If you acquire a entity, like the actual company in the stock as the buyer, you end up taking on essentially 6 years worth of potential lawsuits that could one day come back, right?
Mm-hmm.
And that's usually the reason why they'll essentially restart by just buying the contracts, transferring them over, and hiring over the employees. And so, one very important clause that should be included in almost every management agreement, Bob, what is that clause?
The assignment clause, right? You have the ability to assign the contract to another party.
Yeah.
In most states, if it's not in there, then there's not a law against doing it, right? But
Right.
to completely protect yourself, there should be a clause in there that says you have the ability to assign this to a third party.
Yeah.
So
And
that's really important.
yeah, and there's different levels of assignability. There's the ability to sign without asking the other party. You
Right.
just literally just say, "Hey, I'm assigning these contracts to Jonathan PM. Best of luck." But then there are other assignment clauses or transfer or assignment clauses that have the, "Hey, we at least have to notify you." That's another one. And
Mm,
then there's other ones that literally say, "Hey, we can propose this. You can't necessarily block it, but you do have the ability to like that is your chance to leave if you want to." So
right.
there are different levels of this. The industry standard does tend to be automatic as transfer assign, meaning you don't have to ask your owner or landlord if you can assign the contract or not. But of course, no terms of that contract can change. Right. If anything does need to change, then effectively the new buyer, the new management company needs to sign a new agreement.
That's right. DirecTV didn't ask me when they sold to AT, so now all of a sudden I'm an AT&T client, right, for
Right.
my for my television service, and it's not an uncommon thing. It's quite legal, but
Yeah.
it does come with ramifications.
Yeah.
Some owners are very afraid to tell their, or some company owners are afraid to tell their client property owners that, hey, we sold. In my case, if you do it the right way, and so people understand, okay, why you're doing it, what it means to them, how it could benefit them, being part of a larger organization versus a boutique firm. I did it, of course, very professionally, very transparently, very seamlessly. And I got 2 or 3 people say, hey, congratulations. Nobody left the
Yeah.
company. And so that's, again, I think one of the fears that people have is, oh my God, I don't want to tell my clients, or I don't want to tell my property owners. But my experience is was not a big deal. So I think in terms of the valuation too of the asset transfer, different companies will look at it in different ways. Some people will look at the top line, your revenue. They
Mhm.
don't care as much about the expense line, because the theory is in a roll up, we talked about, that they can help that become better on the books.
Mhm.
They're really interested in your recurring revenue. So,
Right.
okay, they'll fix the other stuff over time
Yep.
and get it to the point where it's to their profitability standard.
Mhm.
Other companies that are buying you, they base the valuation on what's known as EBITDA, interest before taxes,
No,
and
earnings before
I'm
interest,
sorry,
taxes,
what did I
depreciation,
say?
and
Income,
amortization. Yeah,
yeah.
you said interest before. I don't
So earnings, yeah, you're the
Yeah.
accountant, not me.
No,
But
all good, all good.
and they each have their own way of evaluation, right?
Let's talk about this. Let's actually give some benchmarks or numbers here. And I think this is the juiciest part because, like, again, this is something where you can look forward to this potentially, right? And I should say there's a massive disclaimer and asterisk here where there are tons of other factors that that play into multiples as it relates to revenue multiple or EBITDA multiple, right? Or multiple sellers discretionary earnings and how you do add backs and all this kind of stuff. And especially now, I think everyone's aware that interest rates actually do affect a lot of things in the economy. And similarly, or in the same vein, they absolutely affect the valuations of multiples that are being paid. So let's talk about the high level, right? There's effectively like 3 main ways to value these companies, right? You've got top line, you've got essentially top line, but it's really the recurring revenue that people give a multiple on. And then you've got a multiple on EBITDA. So let's start with the top line, right? Bob, if someone's coming to you and saying, hey, I'll give you 1.5x top line revenue, what would you say and or think?
In today's market, that's not too bad,
Mhm.
honestly, right? And
Mhm.
it's what they're giving that valuation on which income lines.
Yeah,
For example, we talked in a previous episode that I had 3 business units. I had the property management business unit, I had maintenance, and I had real estate sales. Which of those are counting on 1.5? Is that the average across
right.
all of them? Are you rolling all the revenue in, or
Mhm.
are you excluding some? A lot of companies that are acquiring in today's day and age, they don't really value the real estate sales because the agents could leave. It's not
Mhm.
recurring. It's a one-time event.
Yep.
And same with maintenance. They might give you some valuation on maintenance, but it may not be as high as recurring
Right.
revenue on property management fees, for example. Yeah. So in today's market, that's not too bad. If you're getting up beyond 1.5, you're probably doing pretty good.
Mhm.
If you look back a year or two ago, I was seeing things as high as getting up into 1.8, 2, maybe even 2.5.
Mhm.
Those days, I think, are gone right now. They may come back when interest rates drop and the market picks up a little bit.
Yep. What about a multiple, let's say, on recurring revenue? And I would specifically now say ARR, so annual recurring revenue, which is really just your monthly times 12. But yeah, what about that?
Let me put that back on you. What are you seeing? I think you're
Yeah, what's super interesting is I actually think the game that a lot of these bigger companies that are backed by tech are playing is they're really just playing an arbitrage game, right?
Mhm.
Because in the tech world, AR, right, or annual recurring revenue, usually trades at 6 to 8 to at its peak like more than 10x, right? And so if you can buy annual recurring revenue at anything less, right? Even if it trades at 6 and you're buying at 5, you're instantly out of nowhere, poof, you're like getting 20% or 15% in just value, right? And I do think one day, in my view, management companies or this revenue is going to be looked at a little bit differently. But the big clarification point here is to be able to trade ARR at that high level or that high multiple, the gross margins or gross profitability of that revenue has to usually be around software style, which is greater than 70%, which I don't think currently anybody in our industry can actually legitimately maintain or attain. Right. You're typically looking at your COGS, which is the people, your property managers or maintenance, people who are actually providing like giving you that revenue. It costs you easily 50% of that revenue typically.
That's why you're seeing also some of these companies, for example, Poplar, who are also trying to build out some technology behind it, right?
Mhm.
So that they
Yep.
can ultimately get the higher valuation. Now, I don't know Poplar very well. I don't know what their technology is, but this is the word on the street. I'm not saying anything that's any trade secret here or anything like that.
Yep. No,
Um,
absolutely.
but yeah, I think that's a really good point. But I guess the way I looked at it is I knew what my profits were in the business, and I looked at how many years would it take for me to remain in the
Essentially, yeah, make the amount of money you're about to give me in one time, right?
that's
Like,
right.
yeah.
And it was pretty attractive, right?
Yeah. And
And
and that's actually getting back down to the third option, which is essentially an EBITDA multiple, right? Or
mhm,
EBITDA multiple. Like that's effectively how people are calculating, which is usually at least in the small mom and pop world or small business world, you typically trade between 3 to 5x
yeah,
EBITDA.
I bet
And that
that
essentially, if
tend
you,
to be
yeah,
the
no, yeah, you could, again, prior 2 years, these definitely trade a little higher, right? But I'd say the more stabilized norm as of today is going to be around 3 to 5. And you know what? If you actually look at it, you're effectively just saying, you're signaling, hey, if I'm paying 3x EBITDA, you're essentially saying it's going to take me 3 years to pay off the acquisition loan, usually, right? Five would effectively say, it's going to take me 5 years to pay this off,
mhm,
right? And so as a seller, you can arguably do the reverse calculation and be like, okay, they're effectively paying me 3 years worth of profit, right? All at once for me to leave, right?
yeah,
Or not to leave, but like to sell to them, whether you stay or not, I think that's a different story, right?
yeah. Now,
Yeah.
there are some variables that impact that valuation, like how tight
Mhm.
of a ship do you run?
Mhm.
What's your churn like all these things we've talked about today.
Ooh,
What's your
how
level?
clean your books are, right?
How's your staffed?
Yeah.
How cleaner, is my liability going to be low? So all these things can affect what that valuation is
Yeah.
because at the end of the day, it becomes an emotional sale too. Now,
Mhm.
that also with EBITDA sales, that's not too different from other types of businesses that
Mhm.
people are buying. Is typically an EBITDA multiple. And we talked
Yep.
about being facetious, but liquor stores and bike shops and gas stations, they all are typically some sort of a EBITDA multiple,
Yep.
which is in that kind of same range.
And if you think about it, real estate trades very similarly as well. Most of the time, banks, the easy way banks calculate is what's your annual rent multiplied by 10, and that's an easy way to value the property. Right now, of course, that's not the expert valuation typically, but that usually they underwrite the valuation of a property like that.
Yeah.
Right. And then they're operating on the assumption that around 30 to 40% will fall to the bottom line. Right. And so they see that as, again, if you think about it, that's about 30 years of payback, right? Or 30 years of a loan is going to pay this thing back. And that's standard in America with 30-year kind of mortgages, right? It's very interesting how everywhere in the world, right, kind of operates around these multiple valuations, right? Um, Bob, so let's finish off here with the actual process, the steps
I was going to go
involved
there.
in selling or buying these companies, right? Because it's not like this happens like to every business owner every day, right?
Right.
Like similarly to a property transaction, like unless you're doing this every single day, you're consistently buying and selling, you probably have no freaking clue what it actually looks like, right? What's the like high level of what are the stages of selling a management company?
Yeah, and I want to disclaimer here when I'm describing valuations and I'm describing this process, I'm not describing my necessarily my personal experience that I had in selling my business. I'm describing what I'm seeing with my clients that are going through the same process and
Mhm.
generalizing it a bit, right? So I don't want anybody coming back and saying, well, that's not how it went, blah, blah, blah. But anyway, or you're sharing too much. So typically there's some sort of a meeting process, there's a casual discussion. Hey, are you interested in selling your business? If you're a property management business owner in today's market, you're probably getting cold called, right? You're probably receiving letters. This is going on right and left. I still get calls, people thinking I still own my business. Say you say, yeah, I'd be interested in talking to somebody. There's probably a conversation that you would have with a business development manager or an acquisitions manager from that particular company who would have a general conversation about it, ask some general questions. There's typically a non-disclosure agreement that gets signed so you can be free to exchange information.
Mhm.
Typically, the property management company owner would provide financials that they can take a quick look at, go from there. And typically, then there would be some sort of an informal kind of back of the napkin type offer. And what I see mostly is in the form of a presentation. Okay, if you were to join us, here's how we would probably structure it or how it would be structured. Here's what we'd offer you. Here's how much cash you would have up front. Here's the number of payments that might be deferred. You could potentially have the option to invest in the company, and so leaving money inside the company as an investor. So these are all different ways that they could get structured. And if that all sounds good and everyone agrees verbally, then there's typically a letter of intent that's signed, right? An
Mhm.
LOI.
Yep.
The letter of intent is typically in the 60 to 90-day range, what I've seen anyway,
Mhm.
my clients. And then you get into the due diligence phase where, okay, now all of a sudden all the deep dive goes in. We're not just looking at the surface level. We're diving in, we're taking a look at contracts, we're taking a look at all the things that might impact the company, maybe talking to the employees themselves, getting really deep dive. And with the goal that if all that comes out clean, then there's a purchase agreement that gets floated, which then really outlines the terms of the transaction,
Mhm.
when the business will close. Is there potential for what's known as a clawback? Like if
Mhm.
properties are lost after we acquire you, can we earn those back or is there not a clawback? Different companies do it different ways.
Mhm.
So that's typically the process how it would go. And then if all things go well, then on a certain date, typically the transaction closes, the money comes in the bank. And then after that, you're usually in some kind of a transition phase the company until the company can actually hire your people, right? You're almost working as a consultant for that company, but that company now owns your contracts. So that's
Yeah.
typically how it works.
Cool. And I think that process in and of itself can easily probably be like a sidecar. We could do a whole nother episode just on that.
Sure. Yeah.
But yeah, I think that's a pretty great initial overview of just look, you should be maximizing profit if you're running a management company. You should always think about a succession plan, whether you're 30 and just getting into the industry or you're 65, right?
Yeah.
And don't have kids to take over, right? This is what's going on in the industry. Hopefully, these episodes have been extremely valuable. Anything else you want to leave with, Bob?
Yeah, I do. If
Mhm.
you're thinking about doing a succession plan, and I would recommend it for everybody, like Taylor just said, reason being is that you just flip the keys to the new owner and walk away. There's typically some degree of transition and turnover that takes place, either the transfer of knowledge or the safe and good landing for your staff. These are all things that people care about when they sell their businesses. The cultural transition that takes place, and then often the owner of the business can be there to help facilitate these things.
Mhm.
There might be things that are practical items, autos that are leased, copiers that are on the office floor that need to get transitioned. These are all things that might end up having to be worked out, right?
Mhm.
So
Yeah,
again, maybe you have an office lease that needs to be dealt with because
right.
the company's going to end up moving. So giving some forethought to these kind of things can really be beneficial, so you can transition as easily and seamlessly as possible if and when the time comes. So
Yep.
that's the importance, not only of, gee, what would I do, or who would it be with, or who would take over, and then what happens if something happens to me, but okay, what would the steps be, and how easily or how difficult would it be to unwind this or untangle this business?
Absolutely. And I will leave it with, if you do have a 5-year horizon, you absolutely should try to take advantage of qualified small business stock, because the difference in your exit is literally your income tax
Yeah.
bracket, right? And most of the time, if you're selling a business, you're going to be at the highest bracket. And so you're literally talking about a 30 to sometimes almost 40% difference in cash that ends up in your pocket,
Yeah.
right? So look up qualified small business stock, talk to people about it, right? I don't think there are very many of the larger players today that will play that game, but this is absolutely, you don't have to sell to a large player. And a lot of times 30% can make a massive difference. Look
Yeah.
it up, if especially if you've got some time left. And yeah, I think that's pretty much it.
That's a wrap. All right. Hey,
Hey,
thank you. Great episode today, Taylor,
yeah,
Jonathan. Nice seeing you guys again, and hopefully we'll connect again soon.
sounds good. Thanks, Bob.
All right. Thank you.
Yeah.